So on today's series, I'm going to share with you guys two very important factors, two great elements in financial markets that makes us stack the odds in our favor drastically in our trading business. Time and chance. Hello everyone, it's your boy Captain Joe here from Fishing for Pips. Let's get right into it. So time and chance. These two elements, these two factors really put the edge in our favor, put the odds in our favor for us to succeed and do well, nice, and become consistently profitable, making profits, making money, achieving what we set out to achieve. Time and chance. Now, what do I mean by time? It takes a specific amount of time for the volatility in a cycle to play out. So that's why we have this 20-day to 60-day time spectrum. Yeah, or this 1 month to 3 months time spectrum. Now, if you look at your local news, you will see the banks are posting millions of dollars every quarter, millions of dollars. Quarterly, you will see it in your newspapers, Express, Newsday, Guardian. You will see it in the news that they're having these quarterly reports. Exponential amount of money, great profits, hundreds of millions. Now, what do they do with all that money? I don't know. They use the bank's money to make money, which means they use everybody's money to make that money. And the bank don't have a bank account. Everybody's bank account is the bank account. The bank is a public entity, and everybody who holds a bank account is a shareholder in that bank. And the bank uses the liquidity provider shares and give it to market makers who are licensed traders, and they go and make the markets up and generate a profit. They create a trading environment to create business with clients, retail traders, buyers and sellers, speculators on the outside, and they profit a lot from making the markets up. 90% of the bank's profit come from trading. About 10% comes from the rest of the things that they do. But you will see every quarter, within every 20 days to 60 days, 1 month to 3 months, every quarter, you will find that they're reporting these hundreds of millions. Now, they're not putting no money into your savings account. If you use your card, they charge you. If you don't use your card, they still charge you. You pay a fee. If you deposit money, you pay a fee. If you withdraw money, you pay a fee. If you put $500 in your account and you go back a couple months, you'll be owing the bank. And if you put money in your bank account, they will suck it out. So, all the millions they're making, they're not putting no money back into your savings account and giving you a little bit of money that they use your money to make. But you will see that the banks are actually reporting, because it takes some time for that cycle to actually play out, of that bearish cycle or that bullish cycle. Right? It takes time for that to play out. Now, what helps this play out? News events that comes every week, right? Or the ones that comes every month. So every first Friday of the month, right? Within the first week, you get NFP. Then going down, you get FOMC. Then you get CPI. You might get PPI. Nice. And you get GDP, and you get some other current red folder news. You'll see it within Euro. If you go to Forex Factory or investing.com or any one of these Forex calendars, you will see the news events, the high impact red folders. And they are there every week. They are there every month. We call them catalysts. They bring the volatility in. So that's why news does not affect us. Because when we trade in a cycle, we are not day trading and scalping close up the price with lines and indicators. We are positioning ourselves to the low of the cycle and leaving it to run. And it could take 2 weeks. 2 weeks here. Or it could take 3 weeks. And, we let it flow over that 20-day to 60-day or 1 month to 3 months. And then we look to trade out profit-taking trades at the end of the quarter. Nice, or whatever. And then we structure our portfolio all over again. So, that news event is happening. So, it takes time. Sometimes one level could be 1 month. Another level could be another month. And another level is another month. So, we get the 3 months there. So, it has 20 trading days in a month because the market doesn't open on weekends. So you're just checking from Monday to Friday, 4 weeks, Monday to Friday, 5 hours are 20. So you got 20 trading days in 1 month. So the cycle can happen within a month. Every level in the cycle can be 1 month separately here, and we trade it like that. So we need that cycle to play out. So time has to be in our favor. It's a great element. It's a great factor that really stack the odds in our favor to be making that money this time horizon. Whether the market going up or whether going down, we just find the bullish cycles, find the bearish cycles, and that is how we looking to play the move. Now, when it comes to chance, right? I don't want to go too deep into it. I'm just giving you guys an overall understanding of time. Time has to do with the time horizon, the time spectrum, the time frame, the time span that we look for the volatility to play out. We don't chase liquidity. Volatility. We flow the cycles of the market, the bullish cycles and the bearish cycles. Now, when it comes to chance, you got to understand, for you to stack the odds in your favor with the powerful methodology and system that we have here, and the way how we can predict the market and perceive and anticipate where it's going before it go there, the way that we understand volatility and how to position ourselves on a cycle, on a level, on a count of whatever phase that the market is in, we could generate very, very high quality, high probability, highly selected trade ideas that will definitely play in our favor. So time is a great element in that. But chance, we cannot just take one trade and trade one pay and try to put the odds in our favor. Just doesn't work that way. For us to put the odds in our favor, if we have a $2,000 account, nice, and we trade in on a 0.20 lot size, we can't just take one trade, put a 100 pip stop loss, $2 per pip, expose ourselves to $200 risk. If this one idea doesn't work out, we could have a good idea, but it still don't have to work out. So if we just take one trade, we have a $2,000 account, you're not over leveraging, you're using a 0.20, $2 per pip, okay, you have a long position, that is, you're using a 100 pip stop for fluctuation, so the market can get room to fluctuate and go in your direction without stopping you out. You're leaving is a fluctuation tool. You have to stay far away from fluctuation tool. You don't raise up your risk and tighten your stop loss to limit your risk. You gotta lower your lot size and open up your stop loss and give the market room to do a thing to go in your direction. Otherwise, you'll keep getting stop out, break even, stop out, break even. Nothing wrong with drawdown, nothing wrong with holding another drawdown and staying a couple days in minus. Once you can predict the market like how we predict it as a high probability, high selected, high quality moves, you have good trade ideas in the right phase of the market. All you need is nice room to stay in that trade and then flow, and you're making thousands of pips going up the road. 1 to 10, 1 to 7, 1 to 8, 1 to 5. Nice, not 1 to 1 and 1 to 2. So here now, you expose yourself 100 pips by $2 per pip, $200. If we take that trade, we could have a good idea, and it don't have to work out. It don't bound to work out. So if it do not work out, well then what else do we have? Do we have any backup? Do we have anything in place? We have nothing? Okay, well, nah, we don't want that. So here's the way you're really supposed to play it. Go on your watch list, generate a little portfolio, and split this amongst 4 trades. So you have a 0.05 by 0.05 by 0.05 by 0.05. Yeah, 50 cents by 50 cents, 1 mini lot, 1 mini lot. So it still come up to 2. You find 2 long positions, 2 short positions. Alright, 2 long positions, 2 short positions. You have the same 100 pip stop here, same 100 pip stop here, same 100 pip stop here, same 100 pip stop here. 0.05. You expose yourself to $50 here, $50 here, $50 here, $50 here. That's the same 200, $100 here, and $100 here. But this time you got 4 trades instead. Yeah, the way how we trade the cycles, 500 pip increment move. So if here is 500, here is 500, here is 500. That's how we target the cycles. So if you're risking 100, we go in for 500, we have a 1 to 5 R ratio. So if you go for 500 here and a 0.05, 250 here, yeah, 250 here, 250 here, and 250 here. The same 0.20 at 100 pips would have been $200. It's the same $200 here. We're exposing. We have 4 positions instead of 1. So we split it down because we want to stack the odds in our favor. That even if our one trade idea doesn't play out, at least it have other trades that could fulfill for it and still keep us in net profit. So even if we one high quality trade idea don't play out, if we generate 4 high quality trade ideas, we still in a better position to still win 1, still win 2, and even if we lose 3 and win 1, we could still make money. One of them trades and them had to play out because we have a powerful methodology and system of how to trade, of how to predict the market cycles. So you got a $200, the same $200 exposure, no problem. If we go for the same 500 pip increment move on the 0.20, 5 twos are 10. We'll be making $1,000. If we add up 250 by 250 by 250 by 250, same $1,000 is our target. So instead of putting one position on with a 100 pip stop and a 0.20, $2 per pip, risking $200 and going for this target, nice, which is the same 500 pips with the 0.02, which will be $1,000. Nice. Why we don't split it in 4? So let's say even if we lose this one, okay, that's $50 down. Even if we lose this one, okay, that's another $50 down, that's $100. If we win this one and we win this one, we still make 500. It's still pick up for them that loss. We still in net profit. But if we only take this one and we lost this one, there's nothing else to back it up. Even if we lost 3, we lost this one, we lost this one, we lost this one. Okay, like $50 by $50 by $50. That's $150. And we win this one. This one still covers for the 3 of them that lost. $150, we still have $100 net profit. That is what we want to stack the time and chance. Gotta give yourself enough chances to be right. Give yourself enough chances to be right. Time in how this plays out, and chance in instead of taking one position, and if it doesn't play out, you have no backup here, or multiple positions in the same direction, and if it play out, you just destroy yourself. When you could use proper risk management here still, nice, and still if you lose more and win 1, you're still in net profit. The methodology and system, the education, the strategy that we use, we show we can generate good ideas, and one of them have to play out. But if we just choose one and it doesn't play out, we don't want to be taking that kind of chance. Nice? We don't want to be taking that kind of chance at all. So even if I have a $10,000 account, and I say, okay, Joe, we're using 20% of the account, $2,000 exposure, right? 0.20, $2 per pip. And then I can split this down. Here, I can split this down, nice, and still build a whole portfolio with it. Have 8,000 here locked in, safe and sound, and generate trade ideas. Nice, long and short, I will be doing extremely well. Nice. It's not just trading one pair or just choosing one direction. You gotta understand time and chance. To stack the odds in your favor, time and chance need to be a key factor for consistent profitability, making money, doing well, growing, nice, and succeeding in trading. Hope you guys learned something, get some value from this. Remember Q1 2026 new student intake. Get on board, don't miss it. 50% off. Let's go get rich in financial markets the right way, slow and steady. Let's go extract money from financial markets, change your family life, change your future, your financial future, leave an inheritance for your children, leave a legacy, generational wealth in God's kingdom, and expand it on earth. See you guys on the inside. Welcome again to Fishing for Pips.